Okay, so next up, let's figure out how to compute free cash flows to owners and our cost of capital for owners. And that's going to be when we're working on NPV to shareholders. Let's also find out how to compute our unlevered free cash flows that are available to everyone and the associated opportunity cost of capital for all stakeholders. And this is going to be when we're finding the NPV to all stakeholders, NPV for D plus E. All right, so let's start with owners. Let's start with how to compute our free cash flows to owners. So these will be our FCFEs. So here's some methods for doing this. For all scenarios, let's consider a simple case to start off with these assumptions. So we'll say we have simple accounting, hooray for that, right? Okay, we'll keep the accounting simple. You accounting majors, you got to go elsewhere for more complicated stuff here. So what do I mean by simple accounting? Let's say that depreciation is the firm's only non-cash expense. And let's say there's no preferred stock or anything like that. Okay, let's keep it simple by saying that the free cash flows are going to be the maximum dividends that can be issued to owners without impairing the future prospects of the firm. How do owners get free cash flows from a firm? They get them as dividends, okay? And when they get dividends from a firm, if that dividend is the maximum amount the firm could issue without impairing its future prospect, then it's a free cash flow dividend. So to owners, important thing to remember, free cash flows always come out of entities to owners as dividends. And finally, let's also say our free cash flows are project risk adjusted. And that corresponds very well to our CAPM model, our opportunity cost investment model, and generally all the ways that we've been thinking about our opportunity cost of capital. That way we'll be sure we have all the risks and we're not double counting any risks. Let's look at a couple methods for getting these quantities for owners. So and we'll use these in method A, we'll use these above assumptions, and we can show, and you can go look at this. I know some of you are so excited about this. You can go, if you're so excited, you can even jump ahead and look in Appendix A to see how this works. But in Appendix A, we show that the free cash flow in a given year I to owners is, as we know, the total cash flow that can be dividended without impairing the firm. And that's going to be the most that we can get to the owners via dividends coming from operations, coming from investing cash flows, and coming from our financing cash flows, right? From our three buckets of cash flows. And now if I just expand that out a little bit, remember that cash from operations, this comes from accounting, and if you've forgotten it, how can I blame you? But cash from operations, if we have simple accounting, like we said we had on the previous page over here, our simple accounting, if we have simple accounting, cash from operations boils down to net income plus depreciation minus changes in working capital. And investing cash flows, if we have simple accounting, is going to be just CapEx. So let me just draw some arrows here. So that one goes there, and this one, our investing cash flows are just CapEx. And if we have our simple accounting, our financing cash flows are going to be just changes in debt. So this is the key formula to remember. So this is one to put down in your helper sheet, and remember that free cash flows to owners in year I are going to be net income plus depreciation minus changes in working capital in year I, minus any capital expenditures in year I. Remember that's repairing our buildings, repairing our planes, if we have planes, maybe buying new planes, that sort of thing, and any changes to debt in year I. And a few more things to say about this is if year I is in the future, which is what it's going to be usually, to get this free cash flow, we're going to have to do what? We're going to have to project an income statement. That's how we're going to get our net income projection. We're going to have to project a balance sheet. That's how we're going to get the debt. And we're going to have to project a cash flow statement for that year. That's how we're going to get the CapEx. So when you do that, these are called pro forma projections. And pro forma projections are just projections of our financial statements into the future. So to get all this stuff that we need, the free cash flow we're going to get from a firm as a dividend for the owners, say I equal to 2 years from now, we're going to have to project and estimate what the income statement is going to look like 2 years from now, the balance sheet and the cash flow statement. And also, what's more, is the financial statements that we project have to be calculated so the dividended amount is the maximum we can dividend without impairing the future of the firm, and that makes it a free cash flow. Okay, so method B, how could we get our free cash flows to owners from method B? We can use our equation from accounting, our roll forward equation for equity. And this hopefully you remember from financial accounting, but again, I don't blame you if you don't, but this roll forward equation from financial accounting says equity at the end of the period equals equity at beginning of period plus additions to equity from net income and paid in capital, that would be issuing more shares, minus dividends. Dividends would be what we give out to the owners. So if we want to use this method, we're going to know ifs, ands, or buts about it. We're going to have to project forward future balance sheet, income statement, and cash flow statement. And we're going to note that the dividend here, if we calibrate these financial statements properly, the dividend is, in fact, the free cash flow amount that goes to the owners. So really all we have to remember here is that we've got this roll forward equation, and now instead of just calling that dividend, if we have everything calibrated properly, this will be the free cash flow to owners. So we just solve this equation for free cash flow to owners. Also, very important to note, if we haven't made any mistakes along the way, numerically what we get out of method A will be exactly equal to what we get out of method B. Why? Because in both cases, remember, we do have to project forward our financial statements. So we're really using the same information. We're just using it in different ways in method A and method B. All right, so now let's see how to compute free cash flows to all of our stakeholders. Okay, so we want to consider the same very simple accounting that we had above. Okay, so let's start with what we had for owners. Free cash flow in year I to owners is equal to net income plus depreciation minus changes in working capital, etc. So this is our method A method, and to adjust this for all owners, it's pretty straightforward. All we really have to do is replace up here net income with EBIT minus tax. And what's EBIT minus tax? That's cash and accruals to lenders and owners. Net income is cash and accruals from operations to owners. So we're replacing that with cash and accruals to lenders and owners. That's what EBIT minus tax represents. Remember, all of our cash flows we want to be after tax. So that's why we include this tax term here. One other thing you should know here is that everyone in the world in finance calls EBIT minus tax NOPAT, and that stands for net operating profit after tax. So you just need to know that NOPAT is equal to EBIT minus tax. The next thing we do is take out the delta debt term, because here we want cash flows to everyone, debt holders as well as equity holders. So now if we substitute that in, the free cash flows in year I to everybody, available to everybody, to debt holders and shareholders, is just NOPAT plus depreciation minus changes in working capital minus CapEx in the year. So you see, very similar. We've just replaced net income with NOPAT. Okay, as with our free cash flows to owners, we're still, to do this, no ifs, ands, or buts, no way around it, we're going to have to project forward, estimate our income statement, balance sheet, and cash flow statement in each future year I. So we are going to need these. Pro forma projections are these estimates in future years of these statements. And as usual, when we do project forward these statements, we want them to be calibrated so that the free cash flow is the maximum amount that could be awarded to lenders and owners without impairing the future of the firm. Okay, so that's it for cash flows. So we know how to get cash flows if we're valuing the firm for everybody, all stakeholders, and we know how to get the cash flows if we are valuing the firm for the owners. So Yahoo for that. Okay, now what is next up? We have to think about what is the appropriate discount rate to use, what opportunity cost of capital to use. So this is going to be two things we're going to look at. RE, that's going to be for owners, and our WACC, which stands for our weighted average cost of capital, that'll be for everyone. So let's jump into this. So what is the right opportunity cost of capital in these two cases, valuing for owners, valuing for everybody? That's going to be what we're going to call, when we're looking for owners, ROCC comma E, meaning opportunity cost of capital for just owners. And when we're valuing the entity for everyone, we'll call that ROCC D plus E. Okay. And so what are the right costs of capital discount rates to use? Two answers to this question. We want to have, of course, an opportunity cost of capital that includes risk-free risk and an increment for our market risk, because we've got project risk in the cash flows, and if we do this, we'll have all our cash flows. So that's good. And in general, when we're valuing a firm, trying to get an NPV for owners, the appropriate opportunity cost of capital is going to be called RE, and that's called the cost of equity financing or the cost of equity capital. And guess what we use for that? Oh my God, I'm sad to say. We typically use CAPM for that, even though we know it's not great. And just parenthetically, let me say here, I didn't spend too much time on this, but we also spent a lot of time with the opportunity investment model. The opportunity investment model is really good for things like bonds where you have contracts and it's easy to find an opportunity cost investment. CAPM is used more frequently in equities when we're trying to value the equity of a firm, because as you know, there are no contracts involved in that. So it's a more mathy, statistically driven model that is used more frequently for equity. You could use the opportunity investment model. It's just CAPM is still, as we know, very popular. Okay. All right. So when we're valuing the firm for everybody, we're trying to get an NPV for debt holders and shareholders. The discount rate that we're going to use is called RWACC, and that stands for our opportunity cost. Sorry. Yeah. Our weighted average cost of capital. Sorry about that. And this is something, again, we just need to know. We have a formula here for the weighted average cost of capital, and it looks like this: 1 minus the tax rate quantity times all this other stuff, which I'll explain in detail on the next page. So here we are on the next page. Okay, so we're using this discount rate, our weighted average cost of capital, when we're valuing a firm for debt holders and shareholders. And what's that? That's when we're getting the enterprise value of the firm. And remember from the previous page, the weighted average cost of capital, which a lot of people just call WACC. Okay, so if you see this, WACC in caps, they mean the discount rate that is weighted average cost of capital. So it's equal to this formula. And what's everything in this formula? First of all, what is RD? RD is our pre-tax cost of debt financing. And we're typically going to use, in the previous chapter, we learned several ways to compute our pre-tax cost of debt financing for an entity. And in this chapter, going forward, we'll probably use this. We'll just go from the income statement here. Remember, this doesn't include the tax shield, even though we're taking it from the income statement. The interest paid divided by the debt at the beginning of period, and we want to make sure we include all the debt in there. Okay. This is still pre-tax because it doesn't have the tax shield in there. Okay. And this is how we get post-tax, by multiplying it by 1 minus the tax rate. Okay, so let's move on here. Tax rate in this equation is our income tax rate, and as we know, 1 minus the tax rate is the effect of the tax shield, and it reduces our cost of debt capital, which is going to reduce, as you can see, our weighted average cost of capital up there. Okay, and RE in this equation is exactly what it was on the previous page. It's our cost of equity financing, which we'll get from CAPM. Typically, we could get it from Opportunity Investment Model. We could get it from a modified version of CAPM, etc. So what are these little W's running around in this equation? We have a WD and a WE. WD is the weight of debt financing, and we measure the weight like this. We measure the weight of debt financing by this ratio, debt over debt plus market value of equity. And debt is pretty much going to be fine to get our debt just from the balance sheet, the GAAP value of the firm's debt. The E here, the equity market value, really should be the estimated market value of the firm's equity. Sometimes, if we're valuing a private company and the estimated market value of the firm's equity is not available, and that's sort of the whole point of the exercise here, then we're going to use the GAAP value of the equity. No shame in that, no harm in that. If you don't know an estimate for market value of equity, use the GAAP equity value. And then finally, we've got everything in this equation now. We've got our tax rate. Our 1 minus the tax rate accounts for the tax shield. We know how to get RD. We know WD is the weight of the debt, RE is our cost of equity capital from CAPM or something, and WE is simply the weight of our equity financing. So that'll be our, hopefully, market value or GAAP value of equity divided by quantity debt plus equity. And also notice that this is equal to 1 minus the weight of the debt. And that also leads me to point out that WD and WD always add up to 100%. So that's another good way to check your work. Make sure these two add up to 100% or 1. So what does this really mean? Our weighted average cost of capital is really just a weighted average of our post-tax RD, right? And our RE, our cost of capital. So that's really all this equation is telling us. Not that complicated, not that big a deal, and it gives us something we can use to discount with when we're trying to get an NPV for everybody, for owners and lenders. All right, a little review on the tax shield here. It's in gray. You don't have to worry about it.